Well, welcome everyone. Thank you for taking time out of your schedule. We have a fantastic webinar here today. The webinar itself is going to last approximately 50 minutes. I would encourage you to stick to the very end. We tend to pack the webinar with lots of good information, and a lot of it is back-ended so that you can have lots of good takeaways and actions going forward. We always want to have the disclosures. And if you do have a question, if you can please email that to us. A little bit different format. If you'd email a question to info@deckmanwealth.com, we will do our very best to answer your questions. If we're not able to get to it, we will get back and follow up with you. Of course, important disclosure information, nothing new. And we have moved. We are in our new office address. We are literally just down the street from where we were. And we have a beautiful office, great views. And we're super excited to share that with you. Hopefully you'll be able to come in, check out the new space. The address is slightly different. Please make a note of that. Phone number and email is still the same. Nothing else has changed. So let's jump in. Let's get into the agenda. Sam is going to lead us through the presentation today. I'll come back at the end to kind of tie things up. We're going to talk about the current state of the stock market and the economy. A lot of good insight as to where we are and where we're going. We're also going to get into an update with regard to tariffs and trade negotiations. And will the Federal Reserve cut interest rates, and what does that mean for you and for investments? Number 4, what you need to know about the One Big Beautiful Bill and the Genius Act. That's something, a new development, very interesting. We'll get into that. And last but not least, investment and planning opportunities. So on that note, I'd like to turn it over to Sam to take us through the program.
Thank you, Jordan. And as he mentioned, there's a lot for us to go over. We're going to be covering many different topics, so we're going to do our best to touch on everything, but we also want to keep it moving. We know that we want to keep these webinars concise, and so in regards specifically to the what you need to know about the One Big Beautiful Bill, we are going to cover the most important topics that apply to our clients. We do not have the time to go over the hundreds of pages that bill is at a webinar that we'll be hosting at the end of the year, which will be year-end tax planning strategies. We'll be able to go into even more depth, but I think that you'll be satisfied with the level of detail that we'll be going over today. So let's start first with the current state of the stock market as well as the economy. The economy in the first half of the year had a pretty big seesaw. During the first quarter, you actually saw a negative GDP, which was mostly a result of companies importing many goods to try and front run those tariffs. And then in the second quarter, you saw quite the exact opposite. GDP came back extremely strong, and you saw particularly the net export part of that calculation to be very positive. So second quarter GDP was over 3%. So when you average the two together, it worked out to a first half GDP of about 1.2%. But we wanted to show this chart in particular to really show you what the main drivers of GDP, which stands for gross domestic product, look like. Now, there's many different ways you can think about it, but really we think it fundamentally breaks down to GDP is the addition of the growth in workers plus the real growth in terms of output of workers. And you add the two together, and that is ultimately how GDP can be calculated. So we've seen in the past, particularly in the 50s and the 60s, that we had both a great increase in the growth of workers as well as the growth in real output per worker. You could see that this number keeps going down and down and down over the past couple decades to where we are currently in the current decade between 2020 and 2025. So with the administration's new policy in terms of immigration and how all that plays out, it'll be interesting to see what the growth of workers looks like, particularly with baby boomers retiring. And we now have Gen X and Gen Z and millennials all a part of the workforce. But I think AI is really one of those main drivers that we think the growth in real output per worker could lead potentially to great economic growth going forward. So it'll be important to see how it's going to interplay between the growth in workers as well as the output that we're seeing from each individual worker in the economy. Now, in regards to profits, this over time is going to be the best indicator for where the stock market should ultimately be. Because intuitively, companies are trading based off of profits, and particularly how profitable the company is going to be in the future. So the purple dotted line that's going across the screen, that shows the estimated earnings per share for the expectation for this year. And the blue dotted line above that shows the earnings per share expectation for the end of 2026. So we can see that the corporate environment still is positive. We can see that here in 2022, it started to dip down. And then since that point where it had bottomed out from the bear market, we've seen earnings expectations go up. And in turn, you've also seen the stock market do well over the last couple of years. Now, in terms of what the earnings expectations look like for not only through the end of the year, but in 2026, they've certainly changed, particularly with the ever-evolving landscape of the trade and tariff negotiations. But I think one important thing to keep in mind again is still that earning expectations we're on pace to do better than what was already expected in 25 and 26. If things continue to roll, that we would probably expect that earnings per share to keep going up. So this is a very good sign that the forward earnings expectations for companies, particularly the S&P 500, keep going up. Now, the other side of the equation, we were just looking at earnings, is prices. So a way that you can evaluate value in the stock market is by looking at price to earnings ratio, or PE. The higher the PE, that means the more expensive it is to buy a company. The lower the PE, that means it's cheaper and potentially a better buying opportunity. So the figure that I want us to pay attention to is right here on the right-hand side of the screen. So the price to earnings ratio, or the PE ratio, for forward 12 months is about 22 times earnings, which is a little bit above the 30-year average. And so in terms of valuation perspective, the stock market by this particular indicator could be viewed as, fairly valued or potentially a little bit overvalued. However, I think that it's truly in the eye of the beholder. If you, as we are very optimistic about what the AI revolution is going to look like and how it's going to really make everyone, between the employees and the companies and businesses and industries in general, much more competitive and much more efficient and, quite frankly, much more profitable, then this, might ultimately be justified in terms of the next 12 months, of course, is what we're looking at. But in terms of the AI race and how we think that'll work its way through different sectors of the economy, it's not just looking at the next 12 months. We want to look at 24, 36, and even farther into the future. But we did also want to give you a balanced perspective in terms of where things are at. And ultimately, one way that you could look at it is the PE ratio, which does say that the market does look a little expensive at the moment. Now, shifting gears back to the economy, one of the main drivers of economic growth is consumer spending. Consumer spending represents roughly about 70% of our economy. So when we're trying to understand how are things looking? We want to first see how is the consumer doing. What we're looking at here is a chart that shows the debt service ratio. So what this says is your debt payments as a percentage of disposable income. So the higher the number, that means more of your disposable income is going towards debt. The lower the number, that means less of your disposable income is going towards paying debt. And when the number is lower, that means that you have a greater ability to spend on whatever it might be, cars, coffee, buying who knows what on Amazon, going on vacation, things like that. And what we're seeing is that the consumer is still being very financially responsible. As of the end of the second quarter, we're seeing that debt service or the debt service ratio at 11.3%, which is much lower than we were during the dot-com bubble, which would be right here, just shy of 14%. And then, of course, right before the great financial crisis, 2007 through 9, 15.8%. So we're still much below where we saw in those other two areas. And so this is another encouraging sign that the economy and potentially the bull market still have a lot of room to run because the consumer is not getting overextended with debt. So now let's switch gears and we're going to talk about tariffs and trade negotiations. We are going to attempt to thread the needle with this next section and just give you the facts. We are not going to be making political statements in either direction. So please just bear with us as we're giving you just the pure economic data as we see it, or at least as has been told. We want to first level set the conversation by going over the 5 largest trading partners that the US does business with: the European Union, China, Canada, Mexico, and Japan. These are 5, I would say, of the most important trading partners that the United States has. Now, of course, there are others beyond this, but these are really the different trading partners in particular that we're looking for progress on. Now, as of last taping here, the European Union and Japan have come and put together deals with the United States. China has put together a limited agreement. Canada actually just had their tariffs increased up to 35%, and Mexico was given another 90-day pause to come to an agreement. So at the moment, we have 2 out of the 5 solidified with deals, 1 with a limited agreement, that being China with ongoing negotiations. Mexico was given a pause. And so it seems like of these 5, Canada is really not looking good at the moment. But we are confident that deals with both Canada and Mexico will come to pass, but it's a matter of when that will ultimately take place. In regards to their total worldwide exports, Canada exports somewhere in the 70% of their total goods to the United States. And with Mexico, it's also in the 70%. So the United States is their largest, best customer. And quite frankly, second place for either of those countries is very far behind. They have no choice but to ultimately come to an agreement with the United States. Now, what that final deal looks like, who knows? Of course, you can see that we certainly export a lot of goods to those countries as well. But in terms of what their exports mean in terms of their overall economy to the United States, we definitely have a lot more leverage in terms of what that negotiation looks like. So we'll be watching it closely, but wanted to just explain that, where we're at with the top 5 partners. Now, this slide shows the different deals that have been announced, discussed a moment ago, that the European Union and Japan. We've also seen agreements in place with the UK, Philippines, and another large deal that was done with South Korea. Now, the administration has come out and they've been pretty clear that they don't expect to do deals individually with every single country. I think that they're planning on doing these negotiations with all of the big players, and then other smaller countries will probably all fit into some sort of bucket. Now, it does seem like the final resting spot for most of these deals is that tariffs are going to be put in place. I think it's a matter of what percentage ultimately is put on to each country, but it does seem that the way that these have been negotiated is that these other countries are opening their markets to US companies, and hopefully that ends up paying big dividends later on down the line. Now, in terms of the frameworks with limited deals and agreements, we spoke about China earlier, which is also a big wild card. We've seen that relationship take many twists and turns, particularly going back to 2018 when the initial tariff negotiations started during the administration's first term. Indonesia and Vietnam are also on this list in terms of limited agreements slash frameworks. So now we're going to switch gears and talk a little bit about the Federal Reserve. Again, we're keeping our comments entirely economical. We are not going to be making any political insights in this part of the presentation. So when we're talking about the Federal Reserve and cutting interest rates, what we are referring to specifically is the federal funds rate. All of the other interest rates that the Treasury is issuing bonds for are freely floating, and the market dictates what happens. But the Federal Reserve is who controls the federal funds rate. So the thick blue line shows how the federal funds rate has ultimately shifted through the years. The dotted red line shows where we're at today, and the dotted blue line on the far right-hand side of the screen shows where the Federal Reserve is projecting interest rates to be in the future. Federal Reserve Chairman Jerome Powell has come out and been pretty steadfast in his view that he wants to wait and see how tariffs are going to work their way through the economy and if they're going to spark inflation. We do feel that inflation has been trending in a positive direction and is coming down. We also believe that that trend should continue, but the Federal Reserve, I believe, is taking a more cautious approach where they want to really be confident before making that decision. Last time we saw inflation as high as we did just a couple of years ago was in the 80s. And the Federal Reserve at that time made a huge mistake. What they did is they cut interest rates too soon, and inflation sparked right back up again. So we're hopeful that the Federal Reserve is being cautious in terms of making sure that we don't have that double dip in terms of inflation. The market is anticipating the Federal Reserve to cut interest rates at least once, potentially twice before the end of the year. And then in 2026, the expectation is that there would be more cuts. Now, in terms of what the market is expecting, if there was to be a cut, it would be smaller. It would be 0.25%, or what we refer to as, 25 basis points. So we'll see. We're not going to try and predict and get in the heads of everyone at that table voting on what to do with interest rates, but it does appear that the table is starting to be set based on different jobs numbers that have come out, and as well as inflation still trending in the right direction, that an interest rate cut is possible before the end of the year. And if they should cut interest rates, we do think that that would be a very positive thing. And the reason why is it makes it cheaper to buy that home. It makes it cheaper to go get that car loan. It makes it cheaper to go get a loan for starting a new business. Whatever you are needing to borrow money for, particularly for businesses, makes it a little bit cheaper as well. So by cutting interest rates, it could help put a little bit more growth and stimulate the economy. So now we're going to be spending roughly about 7 slides going over what you need to know about the One Big Beautiful Bill. And then at the end, we'll also touch on the Genius Act. Now, again, there are many different facets of this bill that we do not have time to go over today. So we are going to be talking about the big high-level points that we think apply to most of our clients here on the call. The first one is that the income tax brackets were permanently extended. When Congress passed the Tax Cuts and Jobs Act in 2017, all of the current tax rates were set to sunset by the end of this year, and they were going to revert back to their higher levels. So part of the bill was not only just extending them, but now they are permanently extended. So that's really good news that we're able to keep the same low tax rates as we've been accustomed to over the past couple of years. Another great benefit is that the standard deduction has been permanently increased, and it was increased starting this year. When it comes to most tax changes, generally they're done prospectively, meaning they begin in future years. But this one in particular actually impacts the tax situation for 2025. So for a single filer, your standard deduction went up to $15,750. And if you are married filing jointly, that increased to $31,500. Now there is a special additional deduction for all of those that are over age 65, and that also begins this year. So if you are just a single individual over 65, you now get an additional $6,000 on top of this regular standard deduction. And if you are a married couple filing jointly and you're both over 65, you each collectively get $12,000. Now, this additional deduction for those over 65 does begin to phase out when your income starts to exceed $150,000 for married couples filing jointly. And this is also in addition to the already increased standard deduction that you get when you're over 65. So there's a lot here. It's a little confusing. Let's give you an example. Tim and Tanya are both 67 and they make $125,000 in 2025. So because they're married filing jointly, their base standard deduction is $31,500. Because they're both over 65, they are both entitled to $1,600, which would be total 1,600 times 2 is 3,200. And then they get the senior bonus deduction of $6,000 apiece for a total of $12,000. So in total, they would have a standard deduction for 2025 of $46,700. So you need to look at your particular circumstance. I don't want to throw a blanket statement for everyone, but for those over age 65 making less than $150,000 in retirement, it appears that you are probably going to receive a pretty nice tax cut, particularly with all of the increase in the standard deduction here. Now, a misnomer that we think was out there was there were changes to Social Security. And the answer to that is no. There are no taxes, or excuse me, no change to the tax on Social Security. Up to 85% of the benefit that you receive from Social Security is still taxable, and that did not change in any way. So if you are still having withholding done on your Social Security benefit, we encourage you to continue to do so because there was no update in regards to that. Another thing that increased was the state and local tax deduction. Before it was $10,000. Now, for both single filers and those married filing jointly, starting this year, it increases all the way to $40,000. And so, yes, it is $40,000 whether you are single or married filing jointly. It doesn't become $80,000 for married filing jointly. Both are $40,000. And there'll be a 1% increase in what this top number looks like beginning in 26 through 29. And then in 2030, it would revert back to that $10,000 figure. However, there is a phase out in terms of the SALT deduction, and that starts at $500,000 in terms of adjusted gross income. But even if you make a substantial amount of money, the lowest number that it could be would be $10,000. It can't go lower than that. In terms of mortgage interest, they ultimately made what was already in place permanent, which is you can deduct interest on the first $750,000 of indebtedness, but a new perk is that mortgage insurance premiums are now going to be eligible in 26 for deductions. This next line item refers to only those very high earners, but itemized deduction limitation applies to those in the 37% tax bracket starting next year. So there's nothing that needs to be done at this moment. And if you are in that tax bracket, we will talk to you specifically. Don't want to spend too much time going over the nuance of this. The last bullet point on this slide is the child tax credit increased to $2,200, and that starts this year. And that's actually going to be indexed to inflation starting next year. Now, there is still a phase out for this as there was before. Single filers, it starts at $200, and for married filing jointly, that starts at $400,000. One of the perks that was given during COVID was that you were able to deduct charitable contributions even if you weren't itemizing. And in this one big, beautiful bill, they actually made that permanent, or excuse me, not permanent, but temporary for the next couple of years until, of course, this will be voted on and decided again. So if you are not itemizing, so said a different way, if you are taking the standard deduction, you can still have a charitable deduction taken from your gross income. So for single filers, you can have $1,000, and for married filing jointly, it's up to $2,000. The rules are that the contribution must be in cash and it cannot be used to establish or maintain a donor advised fund. So if you're donating to charity and you weren't able to itemize it before, this is another perk as well that could help reduce your taxes. Another benefit is auto loan interest deduction, which starts this year and is available for the next 4 years. And you can have up to $10,000 on new loans taken out or refinanced after December 31st, 2024. So this does not apply to old car loans. So if a car loan was started in 2025 or refinanced in 2025, then that would apply. And another condition is that the vehicle must be assembled in the United States. There are new investment accounts, if you will, that are referred to as Trump accounts. And these are to help younger Americans, babies, quite frankly, and set them up for retirement. So the federal government is going to offer $1,000 Trump accounts or $1,000 contribution for every citizen born 2025 through 2028. But the key part is you must opt in. Just because you had a baby does not mean that they're automatically opted into this. So if you had a child or you have a grandchild, certainly let the parents of that child know that they have to opt into this. The investments in this account are limited to funds that track only US equity indexes, and most standard IRA rules are going to apply. So these accounts are to be viewed in a long-term retirement context. So withdrawing before 59 and a half is going to result in not only taxes, but as well as penalties. This is a completely new thing that was introduced, and we're still waiting on a lot of very important answers. Some questions we have is, how do you actually make the election to opt in? That very key piece of information has not been disseminated yet. And then a planning question that we have in mind is, can these Trump accounts be converted to Roth at any point? This could be great because if your child, of course, is in elementary school, they're probably not working a job. So they have a very low income and are in a low tax bracket. So why not just convert it when they're really young over to a Roth so you can get that tax-free growth? So it'll be interesting to see if these have the ability to be converted at any point down the line, because that could be a great planning opportunity. Now, there are many other ins and outs of this, but wanted to just give you a high level taste in terms of what's in store. I'll quickly go through this slide, but this is a summary on clean energy credit rollbacks. One question which we've gotten frequently from other clients is in regards to putting solar panels on their home. So you must pay for that before the end of this year. Now, it doesn't need to be installed before the end of 2025. There is a different date that deadline needs to be done in 2026. But in terms of installing solar panels or any other clean energy to your home, that does need to be purchased before the end of the year in order to take advantage of that. And in regards to the cars, the vehicle must be acquired by the end of September of this year. Now we're going to switch gears and talk about the Genius Act. This is one that you may not have heard much about. It's certainly gotten a lot less coverage, and this is in regards to the blockchain and cryptocurrencies, and the Genius Act in particular is really in regards to stable coins. So what is a stable coin? So a stable coin is a virtual coin, if you will. It's virtual money that is backed one for one by reserves that must be held in US dollars, short-term treasuries, or certain money market funds. So you can think about a stable coin as a virtual US dollar. Now, below is a great graphic which shows why stable coins are gaining traction and why we think that they're going to be a much bigger part of the economy and commerce into the future. So if we look at the top row in terms of the traditional way that money works, is you have a business that transfers money to a bank. They then transfer it over to an intermediate bank, who then moves it over to the bank of the beneficiary business, who then needs to actually get it to the business that wants the money. It changes hands many different ways across the line, everybody taking a little bit of piece of the pie, as well as just delaying the time that it takes to settle different transactions and makes it very complicated. Now, in terms of the stable coin, you get rid of a lot of the intermediary parties. You have the originating business, you have the stable coin, and then it's transferred over to the beneficiary business. We think that this is going to be, again, something that's really going to work its way through the economy over the next couple years, and you're going to hear more about it. We've been getting a lot of questions, so wanted to bring it to your attention that this is very exciting in terms of moving things virtually and potentially reducing friction as well as costs going forward in terms of payments. Other news in regards to cryptocurrencies would be on March 6th, the administration established the Strategic Bitcoin Reserve as well as the U.S. Digital Assets Stockpile. So what could be included in the U.S. Digital Assets Stockpile? That could be Bitcoin, Ethereum, Solana, XRP, as well as Cardano. Now, the administration is certainly making a much more concerted effort to not only help with the stable coins, but also are trying to put more regulatory framework around cryptocurrencies to make innovators in this area feel more comfortable with how to navigate the US legal environment. And so beyond the Genius Act, the Clarity Act is also working through Congress to provide more rules to the road in terms of what investors might or should expect in providing more investor safeguards. Because in the past, it had been a little bit more of the wild, wild west, and this is giving more structure and hopefully, again, providing safeguards to consumers if they do want to consider investing in different cryptocurrencies. We still say we're still advising caution. So if anyone is interested in investing in cryptocurrencies, please talk to us so we can go over your personal situation. But it is starting to become more mainstream. Now let's switch gears and talk about some investment and financial planning opportunities. But before we jump into that, just wanted to explain to prospective clients that are on our call today some different services that we offer beyond just investment management. We're able to assist with retirement planning, which is really putting a comprehensive guide together to help you get to retirement. And then once you are in retirement, creating that sustainable income stream to help get you through your entire retirement. Financial planning, of course, pertains to all folks, defining what your goals look like, assessing where you're at, and putting a strategy together on bridging that gap. And then lastly, we're able to help with tax reduction strategies. And beyond all of these, we help with Social Security analysis, Medicare planning, and much, much more. But just wanted to quickly touch on the various services that our firm is able to offer. One question which we often get is when clients have a sum of money that was either a, let's say, commission check from a business, or they sold a home and are wondering what to do with the cash, or maybe they inherited money and they're saying, okay, I'm a little nervous. The stock market's at an all-time high. Do you think we should wait? Do you think we should get it invested? What is your feeling, and when do you think the timing is right? So we went back and we looked. What does the performance look like if we are to invest at all-time highs versus investing on all other days? And I think what we found is contrary to what many people would probably expect, which is that investing at all-time highs has actually generated a higher return over the next 1 year, 3 year, and 5 year versus just investing during all other days. So why is that? Well, when the stock market reaches all-time highs, generally they happen in bunches. So when all-time highs are set in a particular year, generally it's not once or twice, they happen very regularly. And so when you're setting all-time highs, that generally means things that are going well. So wanted to show this chart to illustrate that just because we're at all-time highs, that doesn't mean that we're necessarily at the peak looking over the edge and it's going to go down. Instead, that could mean that things are going well and potentially there's even more room to run. And the data certainly backs us up going all the way back to 1950. Another encouraging sign is that there's a lot of cash on the sidelines. Over the last year, more money has gone into money markets than all mutual funds and ETFs combined. That is extraordinary. Through the end of June, there's $7 trillion that is just sitting in cash. And ultimately, it will need to find a better home. While money markets are earning a decent return because interest rates are a lot higher than they've been over the last 10, 15 years, if the Federal Reserve does begin to lower interest rates and investors are earning even less money from money markets, they'll want to get it to work more effectively, whether that be stocks or bonds. And so generally when you see cash reach high levels, it can be a very bullish opportunity. So if we look at other peaks, if you will, we see 2003. So this was the end of the dot-com bubble. 2008. Of course, we all remember the great financial crisis and the incredible run that the stock market went on immediately after that. So when you see money market assets begin to increase at, really amazingly high levels, that is something that is very encouraging to us. Now, I hope that you feel that we've given a very balanced view in terms of how we're viewing things, that while we are positive, there are certainly a lot of things that concern us about what's going on in the economy as well as the stock market. And so wanted to show this chart, which gives an illustration on not only what calendar year returns have looked like going all the way back to 1980, but what has it actually felt like during those years with the maximum intra-year declines. So the intra-year decline is this light blue bubble at the bottom. This says, how much did the stock market go down over the course of the year? So we can see in most years that the stock market, went down in some cases substantially, but over 75% of the time, the market actually ends up positive. And what we find is that on average, the market goes down about 14%, at least once. It goes down 14%, but since 1980, the stock market has averaged about 10% positive by the end of the year. So even when things are good, we can still see massive drawdowns. 2020 is a perfect example. We saw the market go down 34%, and by the end of the year, it was still up 16. What would be another good example to take a look at here? 1998, we saw the market go down 19% and finish the year up 27%. So far this year, we've seen a drop of 19%, almost 20%, and as of the end of June, the S&P 500 was up 5%. So volatility is normal. It is expected. Volatility is a part of the plan. We are not thinking that it's always going to be smooth sailing because, quite frankly, the research does not support that. The data does not support that. Even when things are going well, it's always a bumpy road, no matter what. And you can see that very clearly illustrated over the past 45 plus years. And so in order to achieve superior returns through the stock market, we have to be comfortable with the ups and downs, which happen on an annual basis. And every couple of years, we see the stock market go down by a third or more. Ultimately, and unfortunately, that is the price that we pay for superior returns, and we help you navigate and help you guide through that. So let's look at the absolute worst times in history. What would the returns look like if you had been invested when that occurred? So going back to 1926, we can see that the S&P 500, or the largest companies here in the United States, have averaged a little over 10%. So let's say that you got invested right as soon as the Great Depression started. Of course, no one on this call today can actually share that story. But if you were invested during the Great Depression, you still would have had a very great return over the years. Maybe let's come to a little bit more modern examples. Let's say you started investing in 2007, right as the global financial crisis started. If you had stayed invested from that moment up until today, you would have averaged over 10%. And I don't think there's too many people on the call that would have expected the number to be as high. So we wanted to show this to you again to say the only way to achieve the superior returns of the most innovative companies in the world that are here in the United States is to be invested and to be thinking long term. We would be remiss if we did not include this chart, which is just making the point that we want to invest based on investment principles and not politics. We can see going back that the stock market goes up during both Republicans as well as Democrats. So no matter what end of the political spectrum that you fall, we do not want who's in office to be the end all be all in terms of how we make investment decisions. If you are sitting on money in the bank account and for whatever reason you are uneasy about getting invested in the stock market, we still want it working better for you than just a basic savings account. An idea that we have in mind is United States Treasury bill. These are backed by the United States government and are still considered the safest securities in the entire world. And so on an annualized basis, you're still getting anywhere from 4.25% to roughly about 4% if you are to invest in a 12-month Treasury bill. Now, there's a couple perks to this. One is that the interest that is earned is not taxed for state income taxes as well as local income taxes. So that's different than your savings account. That's different than your CD. That's different than your money market. So the after-tax boost that you get from these is a little bit extra. And then also there's no penalty if you sell before maturity. So let's say you bought a 9-month Treasury bill at 4.05% and you need it in 3 months. We're able to sell the Treasury bill and get you the value that it is on that particular day. Whereas if we were to go through that exact same example with a CD, the bank that issued the CD to you is going to penalize you anywhere from 3 to 4 months of interest. So if you have cash, let's find a way that we can get it working for you either in a more conservative or potentially more aggressive fashion. So now I will turn it back over to Jordan to go over some other planning strategies.
Thank you, Sam. Want to recommend that if we haven't talked recently, that it would be prudent to schedule a meeting to determine which of the big, beautiful bill provisions would impact you and would also benefit you, and what planning strategies would be best to implement sooner than later. We would encourage you, if you're still participating in retirement plans, whether it be 401k, IRA, Roth, etc., that you do have catch-up provisions. In particular, if you're between the ages of 60 and 63, you have an even higher catch-up provision available to you. Number 3, there are tax smart distributions from inherited IRAs. So if you have an inherited IRA, it's a very specific, unique type of IRA account. There are ways in which to proactively minimize taxes. Can't avoid them, but there's ways to go about that, and that's something that we can help with. Number 4, Roth conversions. Here we are, early August. It's not too early to start having this conversation. Let's run the numbers, see if it makes good economic sense, and we can together determine whether or not a Roth conversion is best for you. And number 5, and I would absolutely say this before getting into this, this is not something that is for everyone. In fact, it's for just a few folks that have an appetite for alternative investment strategies, whether it's gold or Bitcoin, things of this sort. It's a conversation we can talk about the pros and cons and determine together what's best for you. A few important reminders. Please schedule a review consultation. We're available to meet in person in our beautiful new office. We can schedule a phone call. We can schedule a Zoom call. Whatever is best for you, we're here to help. Something that we can't emphasize enough, every time we do a webinar, we encourage you to review your beneficiaries. Things change. circumstances are different. Please take a look at that. Make sure that everything is exactly as you want it to be. The third item is Social Security changes. So this is with regard to the WEP or the windfall elimination provision or the GPO, the government pension offset. So if you were part of para or you were part of, say, state government, there may be additional benefits and maybe you already have benefited from that, but we want to call that to your attention if you haven't already seen the additional benefits in your Social Security. And number four, cybersecurity. You can't be too careful. We've seen more scams than any time in our career. And this is a time to be extra vigilant. If you're not sure, please, I encourage you to call us, schedule an appointment, again, in person, over the phone, or Zoom, and we'll be happy to go over these important cybersecurity issues. So if you have a question, please email us at info@deckmanwealth.com. And I am just going to take a quick peek here. Okay, looks like we got quite a few questions already. First question is there a change to the required minimum distributions, the RMDs? Sam, you want to take that one?
Yes, and the answer will be very short. No, there was no change. So if you were born between 1950 and 1959, the required minimum distribution age for you is 73. For everyone who was born 1960 or later, the required minimum distribution age for you is 75. So for those that might be asking, what is an RMD? What is a required minimum distribution? For your pre-tax retirement accounts, the government forces you to take money out once you reach that particular age. And so that is what the RMD is referring to.
Thank you. All right, our next question. Are there any changes to Social Security? Sam?
The answer to this question is no. There are no changes in terms of how Social Security is being taxed, and there have also been no changes in terms of benefits. This is something that Congress will need to address at some point, but in regards to the most recent One Big Beautiful Bill, it does not address Social Security.
And okay, next one is my Medicare going to be impacted? Sam?
Short answer is no. In terms of things that are happening on the back end, there are going to start to be some adjustments. But in regards to the premiums that you're paying for Medicare Part B and Part D, or what you can expect in terms of coverage, by and large, no.
Okay. All right, another question here. What about changes to capital gains?
There is no change to capital gains. The long-term capital gains rates are still 0, 15%, and 20%.
Okay. All right. Well, fantastic. Well, I hope you enjoyed today's webinar. We do record these webinars and we will be sending the replay to you this next week. And please reach out to us if you have any questions, anything we can do to help. Please let us know. That's what we're here for. We greatly appreciate your time. Thank you for listening in and hope to see you soon. Have a good evening. Thank you again. Good night.
Thank you.